celebration. This was like the Bible of my mother. She loved your first effort here. What's different about this book than the one you began writing 40 years ago?
Well, the basic message is not different.
Yes.
The basic message is that most people would be far better off simply buying a broad-based index fund. When the book first came out, I think Wall Street thought this was utter garbage, that this was totally beyond the pale. And Wall Street has caught up with the book in that what's the product now that's gaining the most money? It's the ETF,
the ETFs are
which is
them.
Basically an index fund.
Right.
So index funds now have become mainstream, and what's one of the things that's different is that Wall Street has caught up with the book.
And a little humility in here as well. Is there a greater mathematical humility after this crisis, after 40 years of your book? There's got to be a new humility here about the certitude of mathematics.
I think that's absolutely right, and I think there's got to be a lot of humility about what any of us know about the market. The one thing and the only thing that I'm absolutely sure of is that the less I pay to the purveyor of the investment service, the more there'll be for me.
Let's do a formula for the professor from Princeton. Here we are. Victor's quaking in his knees, showing his chew. E to the RC equals RF plus omega C, or whatever that standard deviation symbol is, expected return minus the risk free. It's a Bill Sharp moment from Stanford. Rex, you want me to explain this formula? It's called MPT, which is not for, I need a Pabst Blue Ribbon right now. It's modern portfolio theory. This is the kind of mathematics that got us into this trouble, isn't it?
Well, I don't know that it's the mathematics that got us in the trouble. A lot of people say that efficient market theory got us in the trouble. Efficient market theory doesn't mean that the market's always right. In fact, the market's always wrong. You know, I teach my students, and I don't use that formula. I say, look, the worth of any asset is the discounted value of the cash flow.
Right.
But it's the future cash flow. And I don't know what the future holds, and neither does anybody else. And so market prices are always wrong. What we don't know is whether they're too high or too low.
We're saying cash flow, free cash flow, the disbursement of that to shareholders is a new mantra among corporate executives. Is it the real deal, where they're really starting to redistribute shareholder value to shareholders through share repurchase and dividend increase?
I think it is the real deal, and I think the only thing we ought to be cautious about is most of that cash is actually held abroad. And they can't bring it back to the United States without paying some tax. And I think that's one of the things Congress will probably think about, is there's some way of lowering the tax to bring it back in so that it can be distributed and invested here rather than abroad.
Right. Let me tie in some other Princeton academics here. I think of Avinash Dixit talking about game theory in his book, The Art of Strategy. So much of trying to beat the market, which everybody's trying to do every day. They're not against your book. They read this with a sober attitude, but nevertheless they're out there trying to beat the market every day. There is a game theory involved here. What's the Malkiel game theory that you observe on Wall Street every day?
Well, I think that's exactly the problem, that there is everybody trying to beat the market. The way I always put it is, telling people you can't beat the market is like telling a 6-year-old that Santa Claus doesn't exist. And it's very hard. You know, the 6-year-old doesn't want to believe it. And neither do people in Wall Street want to believe it when, in particular, they're making money out of it. But the fact of the matter is that, in fact, the emperor has no clothes. That if you can buy a low-cost, broad-based index fund, and now you can get this at an expense ratio that's very close to zero, you're not going to get average performance. You're going to get above average performance.
What do you say to the people watching from Wall Street that say, yeah, but I know how to pick an upper decile manager, whether it's John Kerry at Pioneer or, you know, the other big names that are out there, they can find that upper decile manager?
Here's the problem. I've done so much work on this. I look at upper decile managers in one period, and there are some. In every period there are some. But they're not the same ones who are upper decile managers in the next period. The only thing in terms of active management that I've found is a reliable predictor of how they're going to do in the next period
Right.
is their costs. That's the one thing that absolutely continues.
I want to do this with David Rosenberg. We digress a bit here. On Bloomberg Surveillance this morning, we spoke with Rosenberg of Gluskin Sheff and asked him his outlook on housing.
I'm not going to say that there's no reasons for some near-term optimism, but if you're going to look at what one of the possible risks are for 2011 is another significant leg down in home prices and how that plays out in terms of household net worth, consumer confidence, and spending.
I want to do this. The reason I brought this housing up, you could retitle this a random walk down housing. Your thoughts on the housing debacle? It's away from your work, but no, it's not. It's
not away from. It's not away from the work. We've certainly had what the book recognizes is markets make mistakes. They made mistakes with internet stocks. They made mistakes with housing, and we're not going to get out of that housing debacle for a long time. I think the economy is going to do very well in 2011. But housing is not going to be one of the sectors of the economy that do particularly well. We've basically got a glut of housing. We've got too much. Prices probably have to fall a bit more. And I'm not optimistic about housing, but I am optimistic about the rest of the economy.
Page 410, the Malkiel step. Here it is, folks, up on this chart here. The Malkiel step, which is one idea, which is buy a closed-end fund trading at a discount. The Templeton Dragon Fund here, and let's say it's trading at 30, just to pick a number, but it's really worth 36. It's trading at a discount. You still like closed-end funds?
I do like closed-end funds when they're trading at a discount. In fact, that happens to be a fund that I've owned in my own portfolio when I bought it at a 20% discount. The discounts now have been hovering between 8 and 9. If they go up to 12 to 15, I think it's a great buy. Not because I think that Mark Mobius can beat the market, but if I can buy assets at 85 cents on the dollar, I'll do okay.